Right now, retail traders are blowing through their deposits trying to short the top of every single Bitcoin pump. They are reading the market entirely wrong. What we are actually seeing is the setup for a massive mechanical short squeeze. Every trader betting on an immediate crash is unwittingly supplying the exact liquidity that forces the price higher. Welcome back to Crypto Whale Radar. Today, I'll walk you through the macro data driving this squeeze, and later I'll show you a critical warning signal currently flashing on Ethereum. Identifying these squeeze mechanics allows a trader to stop reacting to short-term noise and begin positioning alongside the market makers who drive these moves. This photograph of the charging bull on Wall Street represents the current macro environment perfectly, with the US stock market officially hitting new all-time highs. Equities and crypto share a strong correlation. While not a perfect one-to-one relationship, record highs in the stock market provide a powerful tailwind for Bitcoin. This momentum is exactly why Bitcoin has broken out of the prolonged bearish trend that dominated the charts since last October, transitioning into a clear, bullish relief rally. To maintain this structure, Bitcoin needs to hold the critical zone between $72,000 and $76,000, effectively flipping an old ceiling of resistance into a solid floor of support. But to understand why the bearish argument falls apart, we must look at the derivatives market. This diagram shows Bitcoin funding rates in negative territory, skewing heavily towards short positions. Thus, short sellers pay a continuous premium to longs. Because of this imbalance, long positions earn a steady yield from these fees, even if Bitcoin trades perfectly sideways. All of these open short positions act like a coiled spring. Attempting to short Bitcoin in the face of a macro bull market, especially while paying negative funding rates, is a structurally dangerous move that often leads to rapid liquidation. This liquidation heat map displays a massive cluster of retail stop losses stacked between $76,100 and $76,300. Market makers engineer targeted price pumps to hunt this exact zone. When hit, short positions are liquidated, and exchanges forcibly execute market buy orders, driving the price higher. If Bitcoin holds that $72,000 support level, the math points to the next major engineered squeeze, targeting a fresh liquidity pool sitting around $78,500. However, before you open a highly leveraged long position to catch that move, you need to be aware of an immediate short-term hurdle. This graph shows the 4-hour RSI indicator sharply breaking above its upper dotted threshold into overbought territory. Historically, this signal leads to a brief period of choppy sideways consolidation to reset the indicator. This RSI cool-off functions as a reload phase, resetting the technical indicators to provide room for the next upward leg in the trend. To trade these precise levels safely, you need an exchange that accurately tracks spot prices without hunting your stop losses using artificial, volatile wicks. That is why I execute my trades exclusively on BingX, due to their deep liquidity and reliable order execution. If you want to trade alongside me, using the partner link below gets you access to exclusive exchange bonuses and direct support from my team. This image shows a physical Ethereum coin, marking our shift away from Bitcoin to look at the heavy momentum driving the rest of the market. Ethereum recently forced a decisive breakout straight past its major resistance barrier at $2,400. That upward move perfectly hit the target of an inverse head and shoulders pattern forming over the past 2 weeks. This split graphic shows an immediate warning. While Ethereum's price makes higher highs, the RSI makes lower highs, confirming a bearish divergence. This indicates buying pressure is exhausted. Expect a price pullback to test support between $2,150 and $2,250. This is exactly why professional traders sit on their hands and wait for a support retest, rather than blindly buying an exhausted breakout. We are seeing this exact same exhaustion pattern playing out across heavily correlated altcoins, particularly with Solana and XRP. To stay ahead of these shifts and track where smart money is actually flowing, make sure you hit subscribe to Crypto Whale Radar. Looking at Solana's wider market structure, the asset is trapped inside a massive trading range from $75 to $105. Right now, it struggles to break higher, facing a firm rejection at the immediate resistance block between $86 and $90. XRP tells a slightly different story, having officially confirmed a breakout above its own resistance block at 1.45 to 1.47. But just like Ethereum, XRP needs to retrace and test that zone to prove it can act as confirmed support. Before we wrap up, there is one more immediate setup you need to watch closely, and that is Chainlink. Chainlink is currently testing a critical resistance ceiling between $9.50 and $10, carrying a very high risk of an immediate rejection. If buyers force a confirmed 3-day candle close above $10, it clears the path for a massive run toward the next major target at $12. The data across all of these assets aligns perfectly. The market requires a temporary structural cool-off to digest recent gains before the broader macro bull run can resume. Looking at the state of the market today, the data leads to one clear conclusion. Attempting to short Bitcoin during a macro bull run while funding rates are negative creates a structural disadvantage for your portfolio. The math favors patience. Wait for the RSI to cool off, let the price retest structural support, and then look for long entries. But knowing the overall direction of the market is completely useless if you wipe out your account during those minor pullbacks because of poor leverage management. Click the video on your screen right now, and I will show you the exact position sizing strategy that whales use to survive market chop and protect their capital.